As we start, I think we'll break this panel into three parts and I'll explain each part as we go. And the first part is addressing the job, which is this incredible fiduciary responsibility that all of you need. And the jobs that you do for the quantum of monies that you manage. And I took something out of your website, Mr. Vaswani, and please reflect on this statement because this statement says it all. This website reads that the often unnoticed fact, I'm going very slow, the often unnoticed fact in the skill sets that are required for creation of wealth are very different from those required for its guardianship. I'd like you to reflect and really put the job in front of you in the right perspective because only you can do that.
Sure, thank you, sir. At the end of the day, we look at it as we are fiduciaries of other people's money. And, they've worked hard to get there. Whether they build businesses, whether they've inherited, doesn't matter. Point is, this is what they rely on for their families and their next generations. And it's our responsibility to sort of steward that money. I think too often people get caught up in some benchmark or the other. At the end of the day, it's really to grow wealth. It's about preserving, number one, preserving, number two, growing wealth, ideally in real terms. And that's the other thing I see people do, is they talk in nominal pre-tax terms. All of that's irrelevant. What matters to me is my purchasing power net of tax. What's in my account? Am I staying ahead of inflation? And we're very, very focused on that too often you end up focusing on a benchmark and lose sight of the broader picture, which is to grow your assets in real terms in a prudent way. I'll stop.
Yeah. So Munish, can you take this forward? Creating wealth and managing wealth, what is the difference?
I think creating wealth and managing wealth goes side by side for families. And as Dinesh mentioned that it's preservation first and then growth. But just a small difference there is that the newer family offices who still are in the process of creating wealth, they still give more weightages to creation part of it than the preservation part of it. But I think as Dinesh rightly mentioned, it goes hand in hand. And I think just like to add a bit more that a family's wealth is beyond the actual money wealth that they have. So there's much more of the family wealth that you also have to preserve, and I think that goes into the zone of family governance, making sure if the family has a fight among themselves, how much of money you may have, they're not wealthy, they'll have an issue sometime or the other. So I think preservation both of money terms, their continuity as a family, so that the money stays inside the family, and then creating financial wealth which takes them from one galaxy or one orbital to the next orbital. Which is important. So it goes hand in hand. Hence, Dinesh absolutely rightly mentioned, benchmarks, which is generally preponed by wealth management companies, actually has very low value in family offices, and that's the misnomer people run with.
That's amazing to hear, but Benaifer, you represent a single family office, which is a little different from Mr. Vaswani and Munish. So how do you reflect on, creating wealth or, managing that wealth for your family office?
So, let me start a little 2 steps behind. When we start a new setup in a family office, for example, it's always got to do with a little bit of concern about how to preserve it. And as we come to this side of the journey, 14 years hence, or when we are at the midpoint, you start talking about how to multiply the wealth. So I think that's the transition, because when you're just new into the money, you want to make sure that your capital is somewhere, in a safer ground. So case in point, if I can share my principal's example, is that you see historically, and most people in this room don't really remember the deep losses caused by equity markets. And when I joined and started building my team, we had a lot of resistance to be any amount in equity, right? So that's the difference. And now you're actually being questioned that why are we not 90% equity?
Yeah, I mean, just to get a little deeper, because the crowd is a lot of people who aspire to manage a large amount of monies. Let's talk a little bit about the skill set, because it's absolutely impossible to be so disciplined in keeping your risk profile away from the family's risk profile. How do you do that? I'll again come back to Mr. Vaswani. How do you, make or keep your urge of keeping your thoughts away from what the family actually wants and catering to the need of that portfolio? Absolutely.
I think you have to put yourself in their shoes, their circumstances. The reality is, at least for us, all the money we manage, all is evergreen. In other words, it's for next gen, to gen. Nobody relies on this capital for their annual income, so to speak. But I see, and this is my biggest learning, having done this 15 years, is so you could argue that everyone has the same, all our families have the same risk capacity. But the risk appetite varies dramatically, right? There are those who have FOMO, and a dividend hits the account and they want it invested that minute, right? Not even a day later. And then you have others who are worried about volatility, don't want to see a big drawdown. And I see this as a journey. Our job is to explain with numbers behind it. Obviously the future is not going to play out exactly as the past, but I think it's useful to look at the past as to set up a benchmark. So our job is to show them and educate them, and then obviously have an opinion. But ultimately it is a personal decision based on psychology. And that is the biggest learning for me, having done this all these years.
Munish, you've been an advisor on the banking side also, and now doing a far evolved job on those days. This urge, how do you, sort of restrict that?
So, not an evolved job, absolute opposite job.
Is it?
So when we are a wealth manager and private banker, we are selling, right? And we have to now become the buy side. And that's the biggest change anybody sees in that process. And I think Dinesh touched upon it, but I was speaking to somebody yesterday as well that in a conference that multifamily offices are 50% of the job is psychoanalyst and being psychologists. It's not about money. And this we have learned over the last 11 years managing over 120 odd families, that first year you have to literally de-learn the family and maybe relearn the family and their teams as well. And that's the most crucial time when they actually understand what family wealth is all about. I think that's the change which needs to happen in the first 1 year. After that, I think it's not about pricing, and structurally as well. Just to give you one example, when we launched 5 years back, we had a separate product team and a separate portfolios team. People said, look, you can have a normal investment team of 10, 15 people. But when you are assessing a fund manager, but when you are building a portfolio, there are two different things. You may have 5 approved fund managers, but when you understand the family a bit more in detail, like Dinesh mentioned, the FOMO part of it, if you miss a 3% rally, 3% has no relevance in long-term returns, right? But if you miss that, so you need an active churning kind of a fund manager. Nothing wrong in not churning, but you have to align with the thought process of the family and then attach the product to it. By keeping product and portfolios team separate, you make sure the biasing which the product team may get into, that he's a good manager or average manager, doesn't seep into the portfolio construction of it. So you keep those two parts apart, and the portfolios team has to spend 3 months with the family before the first advice goes out. That's the time you take to understand the family.
I'm just taking cue from that, Munish, and taking it to a CIO, that how do you differentiate between the portfolio and the product?
So it's very simple. At least I've made it simple over the years, because I believe investment should be kept extremely simple. We have a set of family members, right? Some are in some age group, some are in the other age group, some are extremely young. So we designed the portfolio mix or the asset allocation mix based on the longevity of their portfolios, first of all. And also, I don't think it's fair to say a grandson has a higher risk appetite versus a mid-30s individual. So I think that's not the way. I think the mix lies or the truth lies in the somewhere in between, where you're trying to blend the overall return for the patriarch as well as the grandson. So that's the way we approach it.
I mean, that was the first part because we wanted to get into the skill sets required to handle a portfolio, and of course, how do you cater to the fiduciary responsibility. The second part, let's dig a little deeper because the word has actually come out. I picked that up from their website of capital preservation, but all of you have already echoed that this is very contrary to what the job is. You know, the prime job which came out in the conversation already is capital preservation. How does that work?
Buffett, I'm sure everyone knows this. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. Right?
No, because I'm trying to learn here. And when I look at the mutual fund market, when 45% of the flows come in small cap, and now probably 50% of the flows will suddenly go to large caps due to no rhyme or reason, you start wondering, you know, what are we doing? But that's the reflection I will do in this 40 minutes, is I'm trying to figure out.
I just have one more line to add in. Money saved is money earned.
Yeah, so let's look at the portfolio composition and look at it from an odd perspective. What do you think, I'll start with Benaifer, is that, you know, when you look at your approach to portfolio composition, what are those things that you keep in mind from a product composition perspective? When you look at capital preservation, sometimes you would graduate to growth too. What are the portfolio composition made up of? What products?
So of course, every portfolio these days is a blend of a lot of product mixes. The endeavor is very simple. So the way we do it, and I'm sure most CIOs would approach it in a similar manner, is that you first try and see what is the reasonable risk return number that you want to work towards on an annualized compounding basis. And with that, you do a back math of how much should be, let's say, risk assets, how much should be capital preservation assets, and how much should be alternates. And with that mix, of course, when you say these risk assets and capital preservation assets, you have a ballpark return number in mind. So when you're constructing a portfolio, you would try to, so we see a lot of products, right? We are hit by products day in, day out. But we don't buy products because they look great. We buy products only when there is a gap in the asset allocation of a particular sub-segment of that particular individual or trust or whatever. So that's the way we plug and play products.
Mr. Vaswani, your take on the product mix?
Yeah, the way we, I should start by saying that given what I said earlier, that our capital is essentially evergreen, therefore they tend to be tilted very heavily towards equity. I'm sure everyone knows that at an asset class level, there's a 6 to 7 percentage point spread between debt equity. So they tend to be very equity heavy. I'll just add, and then I'll address your product question, that where there is a debt component, we tend to be extremely boring. Because we think to reach for 25, 50 basis points additional in debt, you end up taking disproportionate risk. I would rather take that risk by moving more to equity. So if you look at our debt portfolio, it is extremely boring, you know, tax-free bond or, you know. So now come back to the product question, keeping in mind equity-centric. We're very focused on the fact that you want a level of diversification. When you look through funds, at the end of the day, you're holding pieces of business, right? That's what a stock is. So we want to have diversification, but we don't want to be over-diversified. And therefore, we tend to limit the number of funds that we go into. The other thing I'd add is that, and therefore when we are evaluating a new meaning a different fund, it's always the view is how is it better than what we already have. I'm just not going to keep adding, right? I want to limit the number of instruments, so to speak, because ultimately I want to have a limit on the number of companies that I own. So that's how we look at it.
Munish?
I think before that, just a couple of things. Misnomers about family offices is that one, you can't come out with reports saying average exposure to equity across family offices. You've seen one family office, you've seen one family office. You can't generalize that, that's one. And secondly, I think products are just tools. Products are not the destination for the portfolios. And that's the last stage of a portfolio exercise. And as Benaifer and Dinesh mentioned, that it's ultimately what fits into the portfolio, right? And the process before that has to be much more elaborate than when you're choosing the product. And as Benaifer mentioned, fancy products. Any product which comes in, if it doesn't fit into the profile with an adequate vintage or something, it doesn't have to be in the portfolio. Because even if you don't invest into that one product and that one product is 2% of the portfolio and it doubles in the next 3 months, it won't move the needle. So I think discipline of allocation right at the end of the investment process and making sure there is enough thesis behind investments then leads to the product part of it. Hence, when you meet family offices, single or multi, they're never enamored by what's happening new. They're always about, okay, I'm safeguarding or growing my wealth. Also on the asset allocation side, I think there's a book which everybody should read called The Aspirational Investor. So it turns the head on asset allocation. Basically talks about the need allocation of a family. So part of the family for making sure your lifestyle is taken care of, part of the family for growing the wealth creation part of it. And major part is all about making sure you beat lifestyle inflation. Now lifestyle inflation is not cost of tomatoes, it is cost of traveling.
I'll keep the lifestyle inflation question to the end.
Oh sure.
I have a question.
So Dinesh is traveling today, I'm sure his ticket is costing much more than what it costed 2 years back. And not by 4% increase, I'm pretty sure about it. So I think that's the way you approach it, and then what fits in. And finally, I think product with thesis can find a way. Thesis can go wrong, nothing bad about it, but thesis has to be there. Hence, newer products don't find, audience in that space.
So Benaifer, I'll start the same question to all of you. That very basic, standardized statement for investors at this segment. Are they slowly but surely graduating away from core mutual funds earlier to more structured, more catered, more tailored products like alternates in this space?
Short answer is yes. The reasons are varied. I think as our wealth matrix in the country evolves, more and more sophistication is likely to come into products. That's the first thing. So when you see a mutual fund product, I think more and more, in my opinion, it's becoming a retail participation product. And that is exactly what SEBI is echoing by getting these SIFs into place. That, for some segment, you need a little bit of a different category. So a lot of stalwarts also from the industry naturally went on to set up their own starting ventures, let's say in the PMS side, or join some alternate funds, etc. And that itself drew some capital to move towards the emerging asset classes. Having said that, I don't think that's just limited to that, because we are also seeing a little bit, I'm happy to say that we're seeing a little bit more product innovation. Like we're seeing some warehousing funds, we're way away, but still we're seeing some more, which I have a wish list of. But a plain vanilla category, which is a very big category around the world, like InvIT REITs, is still to be productized.
I largely echo what Benaifer said, except maybe we still have exposure to mutual funds. We tend to look at everything from a lens of the fund manager. So we look at a fund manager and we'd like to see how they've done in that particular seat. It's not that, oh, I've been managing equity for 30 years. Have you been doing it in your current organization, doing the same fund for, let's say, it's a soft number, at least 5 years, because to see how things pan out over time. And then we look at what is the umbrella that we say do it. Is it a mutual fund? Is it a PMS, AI, whatever? So we tend to look at it from a manager perspective, but coming back to Benaifer's point that yes, mutual funds, or let's go beyond that, products that are increasingly retail-centric, it becomes more and more difficult for us because our time horizon is different. I understand where the manager is coming from. They are also managing to people who said, what did you do for me last month? And we don't even look at that, frankly. I mean, it's there, but nobody really sits and says, oh, XYZ fund did, was up or down this much last month. So it has more to do with which audience is that particular fund or manager addressing.
Munish?
As I said, the product is the last stop, right? By that time, you know exactly what you need in the portfolio. And give an example. Supposing you need a go anywhere multi-cap or flexi-cap fund, right? Whoever is the best manager for that product on a post-tax basis, that's the difference between mutual funds and PMSs as well, right? On a post-tax basis makes sense with a track record, I will choose that manager. I mean, it goes globally, it's the same process. The only difference is that sometimes we have gaps in the portfolio. If I'm looking now, I'll give another example, which Dinesh partly touched upon. There is a family who wants to hug the index. They will question you every month if you don't outperform the index, right? And sorry, I'll take names. We are quite open about it. I will not invest in a JM Flexi fund because he will take calls which may be very different from the index, right? With due respect to the manager, and we would love that, in our fund.
That's the manager's style.
That's the manager's style. So, absolutely. So, like you rightly pointed out, it depends on the time horizon, ability to stomach the volatility. For example, if the market has given you 10% last year, hypothetically, and this fund manager has given you -1, you should be able to understand, that there is a reason why he's holding a portfolio at one point in time. I'm not supporting one fund manager over the other, and this happens in PMSs very frequently. They will underperform the market for sometimes a year and a half. So, like Dinesh mentioned, it's about the person who's managing it. If you understand his processes, and the process is not changing also. Sometimes we see PMS managers changing because now they can't see value. Now, with due respect to manager, if you just suddenly change and go into gold completely without naming names, the thing is that then it shows that the thesis is not there. So, I think for us, it's important to understand the manager. Where does the manager fit in? And after that, if he is running a mutual fund or a PMS or an AIF, if post-tax he makes or she makes sense, we are happy to go ahead.
Yeah, I think that's a...
Can I just
Yeah,
add
please,
one
please.
point? Since a lot of industry, I respect the thoughts on both the panelists, but I have a little bit of a different view, and we've been doing that as well. We are not averse to new fund managers, okay? And I have actually done one CNBC, spill where we actually identified 4 young mutual fund managers who were just 1 year down in their circuit, right? I'm happy to say that 5 years hence, all of them gone to do very larger roles in wherever they were or with other organizations. Like some have moved to Kidara, some people have moved as the AIF heads, etc. But having said that, so we are not averse to participating with new fund managers, and I don't think we should I think we should understand the capability of the new thought process as well.
That's fantastic because, sometimes I ask a lot of, on some stages, that imagine if a fund manager picked up stocks the way we buy mutual funds. Okay, the stock is doing well, let it have a 3-year track, then I will buy. By that time the alpha is gone. So what Benaifer is reflecting on is pretty powerful. What Munish reflected on is even more powerful because he's not saying that a fund is bad or good. He picks up a fund which caters to the client. That is what this whole business is about.
There are bad fund managers.
Yeah, there can be. I mean, there are 2 sides to every story. But it comes to the last part of my discussion, and I picked that up from your website, Munish, because your website has 3 peaks as aspiration to reach newer heights in client servicing. The website reflects the Matterhorn, which is the Toblerone biscuit. If some of chocolate, and if you check my WhatsApp profile, my photograph also shows the Matterhorn at the back. It's just a coincidence, but when you look at client servicing, and this is a very different segment with very unique needs, which I picked up from your website, is that when you look at client servicing, what does that mean to say Munish Randev?
So I think, and this goes not just for us, for even multifamily offices across the world, because we are modeled on some of the largest multifamily offices which are out there, and their understanding for the last 40-50 years. I think the family needs a partner. So when I say client servicing, and this happens in the hiring as well, if I'm hiring from a wealth management firm and I call it client servicing, the intent is take the account statement, send it to the client. That's client servicing. For us, it's literally, we don't have client servicing people, we have client managers. So you have to manage everything, where small part of it is the financial part of it. But hand-holding basic stuff, just an example, knowledge lead just listed, right? and after the listing price went up to, so I think today is 107 or something, how does it make a difference in 2-3 rupees share price may not make a difference, but a change of 2-3-4 rupees in the price of a REIT or an InvIT will make a difference on the final yield. Very small thing. The client service manager, the client manager is expected to know that and share it with the family. That's the way the difference happens.
Mr. Vaswani, before I ask Benaifer the same question, because Benaifer's question will be a little different. Mr. Vaswani, what does client servicing mean to you?
I think you have to understand our context, which is all our families that we advise are people who I've known in some way, shape or form for 15 to 30 years. So there's typically a couple of them are people I had invested in before, and now having got some liquidity, they now. So my point is, there's a pre-existing relationship, and that relationship is often based partly on friendship as well. Meaning we may have a dinner together occasionally, we may, and so on. So it becomes, it really is, and often I'm asked about some aspect of their business. We're thinking of doing this acquisition, whatever, what do you think? So it really is just being there as a sounding board and being proactive at times where you see a gap. I happened to have one of these conversations yesterday with a family on something to do with their next gen. And so, it's just, you're there, but I don't think of it as client servicing. It's the people I know, and whether we do it over a drink in the evening or we do it in the office is the same.
Yeah. Benaifer, what are your expectations from your various partners that you engage in? What do you expect from them when they come to servicing?
Wealth managers slash
Yeah,
mutual funds
fund
slash
managers, whoever you classify.
transparency. I think that is the only thing. You call a spade, I'm good. You made a mistake, call it a mistake. We can live with that. Because we don't expect, and even in the job role that I do, everything doesn't go right. Let me give you some examples. We had years back trying to explore different asset classes and different mutual funds. We had put some money in a Japan-based fund and Indian Japan-based fund. And it so turned out that the stocks did well, the currency lost out, and we didn't make money. So it's fine. I mean, it's fine. It happens in every context. In some of my unlisted companies that we have in the portfolio, that we've kind of had nurtured from the beginning, it's not like just invested and kept. You realize that, over the 14 years that I've been at it, the ones who are not going to survive are the ones who are going to, kind of call it a day first. The question is whether anybody who's sitting across the table is as transparent as you'd expect them to be and deliver what they have committed to. I'm not talking about numbers, but I'm talking about the philosophy. If the philosophy is good, we are good, because my allocation is based on that philosophy.
I think a lot reflected on the behavior aspect of it. I mean, lately when the monies in the segment that you manage can be pretty large, do you see a distinct change in behavior toward lifestyle and adapting to various lifestyle changes across the world? Or especially, I'm very intrigued by one part. Do I, as a manager wanting to aspire to manage a large client, need to really brush up my skills on watches? Do I need to know what is a Patek Philippe, what is an Audemars Piguet? Do I need to know that because I should sound, like rightly said, on the dinner table, should be at par with them? Do you see that changing in Indian wealthy as we speak? The veering towards different, luxury? Yeah, because we see new malls coming up catering to that. Do you see that seeping in already? Because it has seeped in globally.
So, I'll attempt to answer that.
Yes, please.
So, 20 years back or 25 years back, you met a ultra high net worth family. The discussion centered around real estate, right? Across the board. If you did not know real estate and pockets of real estate, then you could not have a conversation, right? It changes into equities after that. Lately, it's more been about startups. So when in kitty parties, startup starts getting discussed, you should imagine so you need to know about that. In between, there is a crypto thing as well, and with now SEC approved products there, so that's become, NFT came in for a few months in between. So I think that's on the investment side, but I think on the lifestyle side, every family has some passions, right? I mean, people thought all deals are made in golf courses. Yes, some of them are, right? But not all of them. Not all of everybody plays golf. Similarly, everybody has passions. You talked about watches. People have passions about pen, right? Sometimes client comes to you because, oh, you also know about this thing.
Exactly.
I will work with you. I said, well, good for me, but I think that's not my port of call of just because I also know about the same passion as yours. So I think, and same thing happened. I got a client actually in Switzerland while trekking. Just because you also like it and I also like it, I trust you. Now these are relationships which are built through common passions. I think clients love discussing that. But the worst thing you should not do is attempt to sound knowledgeable when you don't know anything about it.
True.
That's the only thing you should not do.
Benefits and transparency, right? We have around 8.5 minutes and really would like 2 or 3 questions from the crowd. If anybody has questions. Rim sir, you go first.
I have one very simple question. If you are a single office, you close your entire office. For product opportunities, are you open to other wealth managers or distributors of the kind of product, or do you prefer to deal directly with the landlord?
Honestly, for us, it's again very simple, Premji. Whoever shows us the product first, we go with that, if we are choosing the product. Because it can come through a wealth manager, it can come through a manufacturer, the product is the same. So if I find the product fit, I just go with the first in, first out.
So the reality is over the years, we've mostly gone direct, and the reason for that is that we spend a lot of time upfront. You know, it may take us several months of engagement with a particular manager before we get comfort one way or the other. And frankly, the distributor, whatever word you want to use, has very limited, they're just a postbox. It actually becomes a impediment. So I would say more from that perspective, we end up going directly because we can then engage with the manager directly and get a better sense of it.
No, I absolutely agree with that. And needless to say, most family offices, multi-family offices are open architecture players. So because you're open architecture, a product can come from anywhere. It can come from the CA, the investment bank, the wealth manager as well. But wealth managers know that that they will be bypassed in case they come in with a deal with one of the families, because families also look at the cost of investments. So I think in 99.9% cases, it's all direct, even locally and globally as well in institutional share classes.
Before I get into this direct versus regular debate, please note that this is not new to only the mutual, this is for every industry. A hotel will not buy TVs from a particular dealer. They will ask for a beauty parade from the manufacturers. This is true to every trade. So a client above a certain level will want a direct interaction with the manufacturer is a fact across industries. Before we get it, it's a very sensitive topic of our industry.
I know.
Next question for you.
So, what is currently being discussed in PT Party International and on cocktail evenings for the weekend?
Unfortunately, I don't attend any, but
I could have said that for her.
most of them know. I'm in office and then I'm back with my home and my pet. So, but I can tell you what tends to happen is the families tend to have a lot of FOMO of things. So I can tell you what my boss comes and says every day. He will have met somebody and he will say, what do you think about this? Should we do this? Can we explore this? And it can even be a movie that somebody else has watched and he's not watched. So it just doesn't matter. The latest thing in the asset classes is crypto, because that's catching a little bit more, I would say, attention versus some of the other things. A lot of their next gens are a lot of them I know, are into managing their own funds, where they, not in the funds in the sense of in public markets, but they're basically investing in early stage companies, trying to run with the promoters, etc., trying to help them with various things. That's another point of discussion, is my sense. And of course, needless to say, the latest fad, which is latest talk point, has been the natural diamonds versus the lab-grown diamonds.
Mr. Vaswani.
So on the last part, I absolutely agree on lab grown versus this is a constant discussion. Incidentally, almost 50% of our assets under advice are held by, or not 55%, are held by women. So we have an absolute distribution between men and women. So we are part of both the groups. I think what crypto has been in the talk of the town for the last, especially after one gentleman came up in the US. And secondly, I think now the discussion is having, and this is across all large families, is having overseas structures. How do we legally have structures overseas? Because besides that, money has gone out of India with other structures as well. I think that's the challenge, but that's been discussed with the next generation. So we run a next generation boot camp every year. And if that gets discussed by these kids who are 16, 17, 18 in a way, that means they're reading about it. So I think that's very important discussion these days.
Oh, that's a great question, and I mean, most of the guys who come into our office, I keep prodding them to think beyond what they know. So, let me give you some examples. Lots of years ago, when I was on the manufacturing side of an EMC, we did the first gold-linked debenture. Okay, that was not known at that time at all. To do a structured product linked on gold. And you won't believe it, we had planned to raise about, I think, 150 crores. We got all of 7 crores, okay, out of which only one investor was 5 crores, okay. So, this is the reality of new products in an ecosystem, okay. Fast forward now, we see more acceptance. So, let me give you some ideas, like Swarup mentioned, I know there is an international watch index, but nobody has a product around it. Why go that far? We are the most impacted in our country by oil imports, but we have no way of playing oil except for playing it on LME, which is restricted by the flows that we can put outside the country. There are student housing products. You can see, I'm sure most of your kids and mine too are going to these new age universities in India. You know, why can't we read some of those residential halls? Every year I see new residential halls. I mean, Ashoka, Kriya, name them, and they are all over the place having 10, 12 buildings where parents like us are paying. Why can't we read them up, right? Or simple things like, you know, just the InvitRead basket, which is existing right now. I was reading somewhere that it's about, I think if I know the number correctly, $94 billion. And we don't have a product around it. So there's just enough and more to do. Abroad I have seen products on, I've seen a venture fund on vintage cars. I've seen, you know, aircraft financing. So it's endless.
I mean, from a manufacturer's perspective, I'm great that Mr. Pawan just walked in. Vaibhav is somewhere here in the crowd, like my colleague who handles products in the Gift City. We trying to debate of getting in covered call products and tokenization into India quicker than we're talking to all the regulators. Can we get them quickly to India? Because as most of the investors now invest abroad, it's possible that they might take those products there and India might miss out. That's something which... Yeah, that's exactly what every product manufacturer is doing. Yes. One last question, yes. Is it pure or diversification, or does it come with an investment objective?
No, so as I said, we work through a different risk pooled approach or need pooled approach. So one of the risk pools there is the aspirational pool, where you have to grow your wealth at 20-25%. That can only happen in some of these alternate products. But alternates have also changed. 20 years back it was maybe MLDs and ELDs. and maybe some structured debt funds, now structured debt opportunities. But now things have changed. So I think it's more to do with the growth of wealth and not just the diversification part of it. You don't get a daily NAV in a venture capital fund. If you actually got it, you may not invest it, because the way it will move every quarter or every 1 month. So I think it's more to do with creation rather than just diversification right now.
Sir, I'll take 5 minutes more. One last comment from each one of you, because we have a lot of aspirational people wanting to handle large monies. Any word of advice, short advice from
So I'll do something. If you checked our website, that expertise is important when you're dealing with family offices. That has to be trained using your experience over a period of time. But if you don't have integrity at the end of it, the first two things will have no value in the family office space. You do one wrong step there, your complete trust goes on the table, and you will be in the trust business and not the finance business in this space.
Mr. Vaswani.
Yeah, I would definitely echo that, and I'll just link back to a conversation I had with Brain just before this. He was asking about the name of our firm. To me, investing is a combination of three elements, which is some level of intelligence, some level of judgment, and the third, which I don't know how to encapsulate, but I absolutely believe in, is love. So as you sit there thinking about, you're wanting to go out and serve, think about these three. The third one, all you can do is keep yourself educated and be in a position to benefit from love. But the first two elements, I think, are very important for you to think through. Added, of course, or with an overlay of trust and integrity, transparency. You've heard that in different words, but they all mean the same thing, which is, say it as it is.
So the best way to learn any investment asset class is to put your own money to it. So I always do that. You have to experience it yourself before you suggest it to somebody else. And there have been times when I've suggested it to the family hasn't done it, I have done it, and after 2 years I've gone and shown him what that could have done. So I think that's the best way to do it.
Benaifer has her own family office now as well.
Well, thank you so much, ladies and gentlemen. It's been an absolute honor. I go back learning so much. Thank you so much.